and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. On Thursday, the Commerce Commission released the highly anticipated draft report from its market study into competition in personal banking services. As the Commission itself puts it, this is the first competition study of personal banking services in New Zealand, meaning it's the first opportunity to consider and evaluate in depth whether competition in personal banking is promoting outcomes that benefit New Zealand consumers over the long term. To discuss this, I'm joined by Commerce Commission Chairman John Small. Hi John, and welcome to the Of Interest podcast. It's great to have you with us.
Hi Gareth, nice to be here.
So John, your preliminary view in the report is that New Zealand's big four banks, which of course are ANZ, ASB, BNZ and Westpac, don't face strong competition when providing personal banking services. Noting here, of course, that you're focusing on deposit accounts and home loans in this study. So why don't they face strong competition?
The main reason is that it's so difficult for their smaller rivals to take market share off them, and there's a few reasons for that. One is simply, we'd put it in the category of a structural barrier, that the big four just have very, very well-known brands and a strong presence physically throughout the country, and they're very well known and they've been there for a long time. So there's a big incumbency advantage there to start with. Another factor is that the big banks have cost advantages over the small banks, and this comes in various ways. One, for example, is that they have better access to wholesale money markets, international wholesale money markets. They also have had lower prudential capital requirements than any other of the other banks for the last 15 years or so. And so these are quite significant cost disadvantages. As a result of their brand, they have most of the vast majority of the zero interest or non-interest bearing transaction account deposits, which are a terrific source of funding, and smaller banks struggle to attract those, even though they rely more heavily on transaction account deposits than the big banks as a proportion of their funding. It costs them more to get it because they're viewed as being somewhat, more fringe. So there's a bunch of reasons in there, but what it adds up to is that the banks competing against the big four are really up against it.
So in your report, you've got 16 draft recommendations, and the report says that it's important that they're all considered as a whole. And we'll look at some of those individually as we progress. But if you had to list them in order of importance, what would be the one that would come first?
Look, I think levelling up the prudential playing field is very important, and related recommendations to that. This is a pretty significant cost disadvantage. In the order of 15% less capital that's required to be held against the same kind of housing loan by one of the big four as opposed to any other bank. And so, we would really like to see that one leveled up. That's probably as number one, and because that gives other banks a bit of a chance. And then I'd say the next two behind that would be the ones around trying to turn Kiwibank into a genuine disruptive force, and the target and backup recommendations on open banking.
Okay. The one about the capital requirements is a fascinating one. I think. I mean, it's an area I've looked at quite a bit myself over the years. I guess obviously this is kind of where there's the issue of competition and helping out the consumer. And you rub up against here a bit the financial stability issues that the Reserve Bank is obviously in charge of in terms of how it sets bank capital requirements. So you'll obviously be aware that the Reserve Bank did its broadest capital review to date between 2017 and 2019, and banks are required to phase in new capital requirements through till 2028. So that's going on at the moment. I'm just wondering, what's your dialogue with the Reserve Bank been like on this? Because I'm aware, and I assume there has been some. And is there any appetite from them to perhaps further review or make more changes to these capital requirements?
So in terms of the dialogue, yes, we have several touch points with the Reserve Bank. Through this study, we've been engaging with them to make sure we properly understand how the regulatory regimes work that they administer for banking. We also, on the payment side, have been talking to them quite closely because we're doing some work in that area as well. And I've personally interacted with the governor. So there's a few touch points in there. I think that this is an area that, in terms of their appetite, this is something that I'll be keen to discuss with them. I don't think they would be terribly surprised by our view that competition could be enhanced without compromising financial stability in this particular area. Just so we're all aware, the reason that there's this discrepancy in prudential holdings is not because the Reserve Bank particularly wants there to be, but it has its standard risk weightings for particular loans. But the Big Four have an opportunity to do their own internal risk modelling, and the result of that internal risk modelling is that they hold a lot less. That modelling shows their loans to be a lot less risky than similar loans issued by other banks. And so we can see some merit in that modelling. We're not opposed to that modelling as such. And we think it would be particularly useful for risks that are, a bit more difficult and tricky to estimate, such as on business loans and so on. But when it comes to, well-defined categories of home loans, we find it difficult to understand how the risk to a bank changes dramatically. Take a first mortgage on a house with, an 80% LVR or something like that, a well-defined home loan. Doesn't seem to us that it's any more risky for Taranaki Savings Bank to hold that mortgage than for Westpac, for example.
Okay, so that's an interesting one. So obviously that dialogue with the RBNZ, how receptive have they been to the possibility of making changes in this area?
It is an ongoing conversation, and I don't want to speak for them at this point. We did not give them a copy of our report in advance, but they will not have been surprised. As a result of conversations we've had with them, I don't think they'll be terribly surprised that we take this we look at it through this competition lens and where we've got to as a result of doing that. We recognise, of course, that their role is about financial stability, and all we're really asking at base is for them to think really carefully about the competitive aspects of their decisions, and try and explain those transparently when they make decisions.
Now, Kiwibank, you mentioned as the second of the recommendations in order there. So what you've said is that Kiwibank appears to have the greatest potential to constrain the Big Four in the near term and disrupt a market that's otherwise stable due to a lack of competition. So the suggestion here is that Kiwibank's owner, which of course is the government, should consider what's necessary to make it a disruptive competitor, including how to provide it with access to more capital. Now, I mean, obviously this issue of Kiwibank and making it more disruptive, more competitive against the Big Four, as you'll be well aware, has been around really since Kiwibank has been around, so more than 20 years now. The question there is that you're talking, in terms of capital, you're talking billions of dollars probably to get it onto a similar scale to the Big Four. it would appear unlikely that the current government, would want to stump that up. There's always been talk about, possibly listing Kiwibank on the share market. But I wonder with that whether there would be a new conflict emerge between the new shareholders of Kiwibank who'd want dividends and the idea that you're pushing here, that to make it a greater competitive force, which would require it to need its capital to loan money out rather than pay dividends to shareholders. So, I mean, how do you think in practice this idea could actually be pursued?
Yeah, that's a good point. And we're agnostic about how it happens. However, we are aware that it's not an impossibility for it to happen because, if you look back 20 years ago, ASB was in this kind of disruptive mode where they were really going hard for market share. So it has happened, and it could happen again. And we're not none of us have run a bank. We're aware that there's a lot of things that have to fall into line in order for a bank to position itself as a disruptor, as a bank that's aiming for market share. I don't really buy the idea that you couldn't pay a reasonable dividend commensurate with the risk and also grow. And this partly goes to our conclusions about profitability. We think there's probably something in there that there's a margin in there so that investors can get a reasonable return if it was to be capitalised that way. And if it wasn't to be capitalised that way, that the government would get a reasonable return whilst still growing a bank. So I don't think it's infeasible. We don't think it's infeasible. We'll be keen to hear what people have got to say about this. Obviously, we're in a draft stage and we've got our ears on and listening carefully to what people think about it. But our view at this point is it is feasible.
And open banking was the third thing that you mentioned. I mean, obviously, New Zealand's been something of a laggard in comparison to some other countries. Obviously, Australia, UK are two that we typically compare ourselves to. To what extent do you think this is due to the move to the glacial move towards open banking, shall I say, in New Zealand, having been industry run?
I think that's got a lot to do with it. Neither the UK nor Australia have got where they are by leaving it to the industry to design and implement open banking. And if you look around, in the open payments space, where there's a lot more innovation in a lot more countries, same situation doesn't tend to happen by the established industry disrupting itself. It tends to happen by governments getting in behind it and providing changing the incentives, if you like. And that's the way we see it here too. We think that there's a lot to be said for harnessing the knowledge and expertise that's in the banks, but we think that their incentives need to be changed such that they really want to get on and do it.
Another area that's really interesting and that you talk about in the report is customers switching between banks. So, I mean, what do we actually know about the number of customers who do this and their reasons for doing it? And, I mean, how easy or difficult it actually is?
There's quite a bit of material in the report on this. I don't have the report in front of me, but so I'll just give you my general understanding of it. Not many people switch. A low proportion of people switch. So actually, probably we should start by saying what do we mean by switching, because what the banks tell us is that this is a kind of an outdated concept, and that because a lot of transaction accounts don't have fees, what people do is instead of closing down their account, they're just going to open up another one. And it's true that on average, Kiwis have accounts with 1.6 banks on average. So that's what the banks have told us, and it's also what came through, almost exactly the same number came through in our consumer research, so a bit of validation for that one. And secondly, I'd say that switching is easier for some products than others. So, if you've got a term deposit, it's pretty easy to go and find, a different bank or provide or financial service provider for that. But so the area we're switching is potentially more of more import to personal banking competition is in your main bank account, the one where your weekly pay goes into, and perhaps your direct debits or automatic payments go out of, and so that account has got lots of sort of tentacles into other parts of people that you deal with. So switching that account is perceived to be pretty difficult, was the results of the survey we found. But actually people who do it describe the experience as being not too bad. So to some extent it's a perception issue, but the reality is that only a minority of people actually switch.
Yeah, I've got some of the figures from your report here. So the survey that the Commerce Commission commissioned showed that only 15% of New Zealand adults have switched one or more personal banking products in the last 3 years. So obviously that's not a lot. One thing that I've been interested in this area is that the Productivity Commission back in 2014 suggested that data on the volume of customers moving between banks should be publicly available. Is that something you would support?
Absolutely, we would. And here the big contrast, as we see it, is with the UK. So where they have a switching service that's governed sort of independently, and by all accounts it works pretty well. And one of the things it does is it allows you quite a lot of time to do some of your readjustments of your payments and so on, but it does switch a lot of those for you automatically as well. And the other thing it does is it provides public information on how many people are inquiring about switching and then actually switching and who to and so on. So that information, I think, is really, really important. Just one other thing just to note here is that sometimes if it's something like a mortgage, sometimes people get a good deal by not switching, by just threatening to switch. So they, so that what's kind of interesting from a competitive point of view is both the actual switching and the number of people who threaten to switch and get a better deal.
4 of the 16 recommendations, by my count, specifically refer to mortgages, but I didn't see any that refer directly to deposits. So I'm just wondering, should we read into that the deposit market is perhaps more competitive than the mortgage market, or am I just going off on a wrong tangent there?
I think in the case of deposits, there's sort of 3 different categories. There's the on-call, there's the transaction account where you don't get any interest on your money. There's a savings account that's usually got some restrictions on it about how often you can withdraw, but it does pay you an interest rate. And then there's the term deposits. And so I think you're right. I don't recall that we've got a specific recommendation on deposit accounts. But we definitely do on loans. Part of this is that when it comes to there are other issues in the way when it comes to loans, such as just navigating and understanding the rates that are available, particularly when they're phrased as both an interest rate and a cashback, is one issue. Another issue is dealing with the requirements of the CCCFA when it comes to consumer credit, which require disclosing significant amounts of information. So that makes it harder to shop around. So there's a few extra things going on in loans that we didn't see in deposit accounts.
So the report includes a section on bank profitability as well, and obviously talks about how it's been high relative to peer countries. We won't go into the nuts and bolts of that. But one idea I'm just interested in asking you about, and I know you're not a politician, so it's not your decision whether this would happen or not, but obviously some people have been advocating for a windfall profit tax on banks. Do you think their profitability is high enough to justify that, if that is indeed an argument you were pursuing? Not you personally,
No.
just someone in general.
Let me just talk about our view on it, and I suppose it's really my view. So a windfall tax, it's a little bit like when a few years ago we did a fuel market study, and people said, well, what about the taxes? And they don't, because they apply across the board to everybody. They don't really affect competition as such. So, and I think the same thing is true of the windfall tax, is that it would be an impost, a one-off impost on maybe not all the banks, but presumably at least the big four. So it would, it's like, it would mostly come from their shareholders, I think, in essence, rather than from consumers. And I don't think it would alter the playing field, the competitive playing field, to any significant extent. So that's why it's not really, something that concerned us. In terms of, do they have money? Yes, they've got money, and they've got more than that they would have if the market was more competitive. So I think there's headroom in there.
Okay. This market study was obviously commissioned under the previous Labour government. We've now got a new government in place, and obviously each government has a different agenda. And they have been talking about having a select committee banking inquiry, and they've said they'll wait till your final report before they go ahead with that. But I just wonder, are you concerned at all that this market study could get lost in politics? Because obviously, at the end of the day, whatever your final recommendations are, if they're to happen, the government has to choose to enact them.
Look, that's an occupational hazard with market studies, Gareth, and we don't have the power to do anything. We have the power to analyse, shine a light on things, and make recommendations, and then others have to decide whether to pick those up and run with them. Here, there's a couple of recommendations that are targeted at government, and so maybe a bit more than that, but. So it's up to them to decide. Obviously, we're very much, it's not our job's done basically once we hand over the report. Although we do like to supply a bit of aftercare where we can if people are, struggling to understand what's going on. So in terms of the select committee inquiry, though, I think there's plenty of scope for other work in this area, to be honest. And so if a select committee was keen to get cracking on an inquiry, then I would think that our report would provide them with a good foundation from which to build, and that there would be a number of other avenues that they could look at that would be complementary to this work rather than cutting across it.
What would they be? And I mean, obviously this is personal retail banking services and deposits and mortgages in particular. So there's obviously, there's other areas within personal banking services that you haven't looked at, or you've looked at in a relatively small way. But of course there's business banking and there's rural banking and those sorts of things as well. So, and especially banking for small businesses. So are those areas where you think they could get stuck into?
Yes, I think so. Very, very much. I mean, it has been said. I don't know whether it's true or not because we didn't look at it, but it has been said that the regulatory regimes favour home loan lending over business lending, and do so unduly. And I don't know whether that's true or not, but that's something that they might want to be interested in, and you could see why a select committee might want to look at that, since it's it goes to the innovation and growth capacity of the economy. And the other one that has been in our rounds talking to the bank CEOs and senior leadership teams, that they've told us about at length is just the overall level of regulatory capital. You mentioned it yourself, that the new standards which are being progressively introduced through from now until 2028. The banks tell us that they're going to have to hold twice as much capital as any other country, and they think that's a big burden. So I don't know whether that's true either. But these are the sort of areas. So I think there's quite a lot for a select committee to get into if they wanted to, and I think our report would help them.
Okay. I mean, in terms of the recommendations you've made, and I'll note, of course, these are draft recommendations, and you have said final reports due in August, and your recommendations may change because you've got more consultation to do, etc. I'm just wondering, I mean, the big four banks are really sort of fingered as the bad guys here from a competitive perspective. Now, I mean, they are, as we have discussed, they're very well resourced, they're profitable, they're influential, and they tend to be effective lobbyists as well. So, I mean, just how much pushback do you anticipate from them?
I'm going to be interested to see that. We haven't accused them of doing anything nefarious, and they're responding to the incentives that are in front of them. We think that they've settled into a particular pattern of conduct that we think should be disrupted, but we don't blame them for that. So I don't know. I'll be really interested to see what they do have to say about it.
Okay, look, just to wrap up, John. I'll again emphasise these are draft recommendations, but they're the best ones we have at this point until we get your final report. So, I mean, if these were, adopted wholesale by the government tomorrow, what would be your sort of best case scenario of how the New Zealand competitive personal banking landscape might look 5 years from now?
Well, look, I'm optimistic that if that was to happen, that we would see things that we just can't imagine today. So if open banking is operational within a couple of years, if Kiwibank has already been disruptive, then I think we've set the industry up for a really healthy competitive future that will be greatly beneficial to New Zealanders of all, throughout the economy. And that there'll be that rates will be sharper, and the range of services will be much wider, and the choice between trusted providers, will be much wider as well. So I would see it as being really positive 5 years from now.
Well, look, thanks so much for that. That is John Small, who's the Commerce Commission Chairman, and I'm Gareth Vaughan from interest.co.nz with another episode of our Of Interest podcast.